very much, Mark. And look, I know because we ran the session earlier on this week in Melbourne, what excellent content it is and what excellent insights all of our presenters bring to this. And I want to re-echo Mark's point about this is a masterclass, not a lecture. I'm sorry that you're in the, that we had to set the room up this way, but so interactive is better. Now we're actually in a slightly different order than this for this session, and I wanted, because Patrick Nalty is flying back to Melbourne, and so we've rearranged to accommodate this. But in particular, I wanted to thank Patrick because he's not feeling 100%. So he flew up this morning to go gentle on him. Now look, I asked Patrick to take part in this because I've known Patrick for over 20 years. He was one of the very first clients of IAS at Paradigm, as we were, which is now Explore Wealth. As we were starting the MDA journey, Patrick recognised the value that it could add to Paradigm now. And so Patrick, over the 20 years, has built a business in advice in this high net worth market based around managed accounts. And so Patrick is, as I said in Melbourne, if Patrick can build a business to $1 billion and sell it to an enthusiastic buyer, if he can do it, anyone can do it. So look, thank you very much for getting off your deathbed, Patrick, and I'm looking forward to you talking about it.
Cool, thanks. Look, thanks everybody. Look, a little bit about Paradigm to sort of put it into perspective is that we set up Paradigm about 20 years ago. We set up with one purpose to actually really, get in and service I don't like using the word high net worth client. I'm still yet to come up with something, but for one of this lecture or chat is we call them the mass affluent, and that was our target market. We wanted to build a business because we thought really on the journey that there was a whole bunch of firms that were really targeting the ultra high net worth, and they were people like JB Ware, UBS, Prestone, Escala, etc., etc. And then there was the mass market, which was targeted by the banks, and the banks were very much focused on the mum and dad investor and getting heavily involved into that market. And we thought, well, there's this market of people who have worked hard all their lives and ultimately sold their business, and they have somewhere between in our target market $1 and $5 million worth of investable assets. So we fundamentally have ended up building a business with 400 clients. We have $1 billion that we look after. We run a majority of that through a managed account, and I've done that with 3 advisors, and we've got 15 staff. So, and Toby's right. Like, if I can do it, because we got no help. We're the only business. I was just talking at one of the other guys before, and like we only ever bought one business, and we bought one business with 300 mil. So we've never bought another business. So you don't have to go off and do it by business. If you focus on what you're doing, you can really achieve the result. So it took 20 years, but it is possible. Look, now in researching this little chat, I came across a paper which was done by Netwealth. And we don't use Netwealth, so it's not an advertisement for Netwealth at all. But it was a very, very interesting paper, if you search the net, which they did, the Advisable Australia in 2022. They did a data set of 1,500 people and they researched them, and their research in this paper is quite interesting. So I've copied it, hopefully, I've got an acknowledgement there, yeah. I've copied it to sort of try and share that with you. But, there's the emerging affluent, and interesting stats there. The average age of that cohort is about 34, and they have account balances of about 700,000. There's the emerging mass market, they're about 33, and they've only got account balances of about 150,000. there's the established mass market, and they've got account balances of about 500,000, and then there's the wealth, the established affluent. That's their stats, and it's really, really interesting. Average age is about 60. And this is when you're focusing on what you're trying to do with your business, you've got to really focus on what your target market is, and then you've got to build your business around what that target market is. They've got account balances there, as you can see, their super and their investment portfolios, about $2.5 million. So that cohort fell directly into the cohort that we were after. Now, 50% of those people are looking to engage with a financial advisor over the next 3 years. And remember, with the ageing population, there's more and more of this cohort that is falling into this bracket. So, there's 2.8 mil, average, they're 45 plus, but the average age is 60. They've got, there's potential for 2.8 million Australians, 50% of which are looking for advice. So 1.4 mil, and that is serviced by only 12,000 advisors, because the advice market has dropped significantly. So, and they're desperate to try and get some information. I've gone through this, but that was sort of like the background as to why we targeted that market and why we went after that market. But they're an interesting group because there are top 5 areas, and again, this is out of the research, but it's exactly what our firm has found as well. Everybody gets sort of wrapped up in as to what sort of investments do they want, etc. I can tell you right now that this group, which has worked all their life, usually mum and dad have both been working. They've got to their age where they're thinking about retiring or are going to become retired, and a big number 1 criteria that they're interested in is cash flow. How do I keep driving the cash flow that I need to keep giving me the lifestyle that I require? The other criteria is that they want to ensure that their wealth is well managed if something happened to them. So if something happened to either of them or one of them, is there a confidant that they have, the advisor, that I feel very comfortable with? So if something happens to me, there is a transition that somebody can help them keep from managing an ongoing advice side of things. They're actually really interested in tax minimisation because it's all, and that's why they're also interested in fees to a certain degree, because it's all about maximising this cash flow. So they're also, very interested, and again, this came out of the study, very interested in how do they minimise their tax exposure, and they want to feel that they've got a great sense of well-being and peace of mind with their investments. So again, very conservative investors. So the advice and the wealth goals established are different. They're very cash flow orientated. They're more mature. They're very engaged with their families. They're very keen to add some value to help out with the grandchildren, help all of them to a person who's sort of keen on sort of paying grandkids school fees, etc. And they very much want to be educated. They want to be part, and we have found this over the journey. Like I said, we've spent 20 years developing this. We always found that if we educated them and gave them a position of that they knew what we were talking about, that when we suggested things along the journey, they were engaged in the process. So if you lecture your clients and you go to them, and I know I'm sort of probably teaching you things that telling you things that you already know, but it's interesting to reaffirm it because they've got to be part of the collaborative engagement process of helping you with the selection of their investments and their decisions. This again came out of the study. They welcome technology. The other thing that and this is again why the managed account sort of worked very well for us, because they want to know that there is a second source of truth in the engaging of their investments. So if they can access their portfolio online, and that portfolio is so it's not because of the managed account, it's not unit price, for instance. They actually hold the underlying investments in their names. And they want to be able to have a source of truth that they can go, well, my advisor told me this. And if you follow the tech that a lot of managed accounts can actually give you, you get your portfolio online, you can see your dividend flow, you can see, and I'll stop for a second because I just want to explain the way we run money. We truly run a discretionary account. So those portfolios, we have an Aussie equity portfolio, fixed interest portfolio, property portfolio, etc. But the underlying investments that are held in each of those portfolios, there are direct shares that are held. For instance, in the Paradigm equity portfolio, there are direct shares held. We don't make the investment decisions of those direct shares. Those investments, we use an external portfolio manager under mandate. So we go to that portfolio manager and go, we want you to run our Aussie equities. We'll give you a $200 million mandate. We negotiate the fee. So they make all the investment decisions as to the buying and selling the share. Same happens with our fixed interest portfolio. Same happens with our property portfolio. But the tech is reported overnight. The portfolio's done overnight. The dividends flow from that into their cash management account. So they can follow that whole journey themselves if they want. So be aware that whatever you do when you engage with these people, they're actually very interested in the technology side and the type of tech that you use. They're very interested in wealth transfer because they're getting to that age and they go, well, how do I engage with my children to get them to understand the process that is required? Because if they're going to pass down $2 or $3 or $4 million down to their children, they want their kids to start getting involved into what that means to them. So again, you've got to have a process whereby you offer the facility to engage with their children to start teaching them about the way of the world. They are very wary of one size fits all. So they, again, are looking for a bespoke offering. They're looking for, make me feel special, make me feel a little bit engaged in the process so that I'm not fitting into a cookie cutter size of type of environment. And interestingly, their asset allocation is split between, and when we talk about the property side there, that is that they all seem to own a rental property or something like that. So property is 26, equity is 25, and cash 11% respectively. So it's sort of interesting.
You talked, Patrick, you talked about the fact they want to be personalised, but you're running portfolios. I mean, how have you found the MBA structure kind of supported that as opposed to, say, going to an SMA or...
Well, the MBA structure is smoke and mirrors. And why I say smoke and mirrors, because fundamentally the job of the advisor in our firm is to engage with their client and then to set the asset allocation. But the way that it flows through is that, so they do the asset allocation. So either someone's going to be overweight equities or overweight fixed interest or overweight cash or overweight property. But the way that they see the portfolios is that because the client gets this bespoke portfolio, they actually see that they've got the direct equities that exist in that portfolio. They think that that equity portfolio, those direct equities, has been chosen for them. It's not. We actually have an external investment manager that actually is making these changes and is actually trading this portfolio. So it's actively trading portfolio, and they see when they look online, they see that the portfolio is actively traded. And at the end of every month, we give them a note that comes out of our portfolio managers, and in that note, it actually explains what the major trades of the month were. Why, for instance, why we sold BHP and bought Rio. Why we have traded a particular, why we've sold a particular stock and bought a new stock. So they're actually aware that the portfolio is getting actively worked on and managed, and the advisor then engages with them and explains in depth as to if there's any queries as to why that was done.
Do they know that portfolio is outsourced as well?
Yeah, they know that. Yeah, because what we do every quarter, we have an external investment committee that meets every 2 months, and that external investment committee takes a top-down approach, and then every quarter we get them to come in. The clients have got the ability to come in and meet the investment committee as well as the actual individual managers. Because the great thing about the way the MDA works, because we're the investment manager, we hire the investment manager, we can sack the investment manager, and all they need is 24 hours notice. The portfolios stay exactly the same. New manager comes in and takes on the mandate and then makes the adjustments that he needs to on those portfolios. It's when we first started Parallel, we had 26 staff and probably 300 mil of FUM. We're now 14 staff and $1 billion of FUM. I mean, the efficiency we get out of it is fantastic. And that's, if you're thinking about engaging in managed accounts for a high net worth client, like you get a massive efficiency again.
Sorry, Patrick, if I can interrupt 1 second. If you have a question, could you put your hand up? Because we're videoing, it's much better if you have the mic. Thanks.
What kind of scale, so, like I'm in a startup phase and, I've got the clients that are all in that same category, but, all but there's 60. And so growing and don't have the resources and the funds myself yet to, go down the path of doing that. But what sort of funds under management size do you think, you get to before it's worth looking into something like this, as opposed to an SMA or other blended managed portfolios that you're running yourself?
Well, Brett there, he'd probably go. He'd probably go like.
Bespoke portfolio, 100 million.
Yeah.
All asset classes, not just equity. If you're off the shelf, probably do it for 50.
For us, because we operate a slightly different model to what Brett does. I'd go to, because it's mainly for that a sort of slightly different client base, but I'd go 200 mil. 200 mil for us is where you can really get some scale, because you've got outlays of your investment. Like when we first started, we didn't have, we've got 2 internal portfolio managers who do nothing but just manage because we do all the trades now as well. So, the manager, for instance, says we're buying this and we're selling that. We'll do the trades in-house for the client. We have these portfolio managers that are actually constantly monitoring the performance of the manager, writing all the notes, doing the quarterly reports, etc. So as you grow and as your fund grows, and one of the things we did, we had 250 mil, we bought a business with 300, gave us 550, and then we were away. Then we got leverage out of that, and then we were well and truly on the journey. When you try and design a practice around what it's got to look like going forward, it really does come down to, I can't emphasise this enough, the quality of the advisor and the quality of the advisor that you hire. You want them to be able, they've got to understand and be able to engage not as a financial planner, but more as a confidant, as, they're looking at you as their source of truth, their advocate, to go, well, I need a recommendation to an accountant. I need a recommendation to a lawyer. We don't do any estate planning in-house, for instance. I think that's fraught with danger. But we introduce them to specific lawyers which are specialised in estate planning. We introduce them to, we're going through a thing at the moment where we've introduced them to a new accountant who's a very wealthy individual, because her accountant wasn't up to scratch on the type of work that she wanted. And so they came to us and said, can you recommend an accountant for us? We've built our business out of getting referrals from existing clients. We've never gone looking for referrals out of the accounting profession. So you've got to have an advisor that understands trust, discretionary trust, self-managed superannuation funds, the way estate planning actually works, the pitfalls that can exist. And they've got to be able to handle things when people get divorced. They've got to be able to engage with them on a really sort of superior plane that allows them to go, that's my advocate that is working for me every time. Again, this came out of the research that Netwealth had done. Yes, sir.
So you might be touching on it soon, but where does philanthropy come into it with that client market? Is it something that you, the Paradigm, will proactively talk to a client about, or do you do it reactively when they bring it forward, structured giving, perhaps, and so on?
No, well, we engage with them as to, like, we have families which have their, and it's simple. It's like, we don't get involved in the big trusts, for instance, but we have families, for instance, whereby the kids go, well, mum and dad go, well, we're going to invest $1 million, and the kids are involved in the investment decision, and the earnings out of that $1 million will go to one of 3 charities, for instance, because we don't get involved in the complicated structures of setting up philanthropic trusts, etc. Because if they've got that much wealth and they want to get involved in that, we again send them to one of our, like we use picture partners a lot for accounting, so we'll send them the pictures to get some proper philanthropic trust advice. Otherwise, we go, we'll get your kids together, they all come into our board meeting, they all kick the can around, and, of the $1 million, for instance, it might have $70,000 of earnings that it's done for the year, and the kids go, well, we're going to pick 3 charities that we're going to split that 70 grand. So they keep the capital intact, and they get to use just the investment earnings on that, and therefore it's a great way of getting the children involved in understanding how investment markets work.
What happens when the kids get interested and they want to become clients? And they've got 100. What happens when the kids become interested and they've got 200 grand to invest and they want to become clients? What conversation do you have with them?
Yeah, and we welcome that. Like we don't go looking for a client with 100, but we don't turn around and go to the kids. So on that, like they don't necessarily sit in the MPA, but we still run BT Panorama or a Colonial First Aid, and we'll put their funds into that. Or we've had other kids that go, well, pick 5 stocks that, like I had one recently and it was like, pick 5 stocks that, was 80 grand. And go, well, pick 5 stocks. You do the research. You come back to me and go, what 5 stocks you like? Came back with JB Hi-Fi and Cotton On and da-da-da. And, and then you go, well, why did you pick those stocks? You get them engaged. So, and we can, again, in our MBA, we have a thing called a tailored portfolio. And that tailored portfolio is for anything that doesn't sit inside any of the model portfolios. So there's 5 model portfolios. And then on top of that, we have a tailored portfolio. That's for instances like that, it can sit in there. It might be they've inherited granddad's, 500,000 BHP shares. Doesn't again, only 100 grand in the model portfolio will it'll take the other 400 grand. So you use the facility of all these things because by doing that, you're not triggering a CGT issue. So you can, one of the great things about having a managed account is that you can tailor these portfolios which suit you, the way you operate your business and the way you operate with your clients. But there's certainly no drama in, we'll take on kids, the younger kids. And as I say, they want unique offerings, they want a full suite of services. They're interested in bespoke offerings. We do some property syndication work and we go to them and say, we've done a lot in the food and fuel sector, particularly with United, and we develop bespoke properties, in the food and fuel, 15-year leases, 7.5 prior to interest rates going up, they're paying 8% returns and get the capital growth on that. Again, unique offerings, they like to be introduced again, getting away from the cookie cutter. Doesn't matter if they don't take it up, it's just the fact that you've got something different that you're happy to talk to them about and they get to participate in the decision-making process. That's what I mean with it, especially quality of service, quality of advisor. One of the things Toby in his notes say, how do we charge? We're pretty simple the way we charge. We charge 75 bips for the investment management process and we take a transaction fee. So all up, our total cost to clients about 125 bips. Out of that, we sort of take roughly, our take home on that's about 90 points. So, and on top of that, we will charge an advice fee for specialist advice that's required over and above what we do on the investment portfolios, because some of that advice can be quite technical. And as I said to the group in Melbourne, we've always used Jim Stackpool's sort of need and complexity. Yeah, thanks. So the higher the need of the client, the higher the complexity of the client, the higher the fee, and hopefully that over a period of time you've taken the complexity away because you've solved their problems, and therefore, so we don't charge an asset fee on any of that. We charge a flat fee that's negotiated with the client. You've solved their complexity issues. It might be really complex to start off with. You solve that, and then their fee drops down. Their ongoing advice fee drops down, but you're still getting your asset fee out of the investment management fee. So again, you're negotiating with them when you see them. Say, well, we've got this asset fee. That's what, that's the portfolio work that happens. But then if you want proper bespoke advice, well, you've got to pay for that, and that's a negotiated fee. We're going for time.
Good. Couple more minutes, and if there are other questions, are there other questions for Patrick? Yeah.
What about reporting? What does your reporting look like? Do you break it down by, presumably you break it down by asset class, and you report each asset class time weighted against benchmarks and those sorts of things? Or how do you?
We use IAS is which used to be Explore, which is now Explore, which is owned by Hub24. Toby worked originally at IAS. That does all my report. Like what? It's again one of the.
Didn't work in it.
No, we use. It's really, really good software. It does all the reporting. It breaks it down to asset class. It brings all the. It flows right through. We use Class as SMSF admin. Talks directly, seamlessly to Class. No human intervention required. Brings it down to, what your dividends are, what your frank, unfranked credits is. Does the whole works. But we give clients every month a very short form summary of their portfolio, and then if they want to do a deep dive, it's a very comprehensive reporting structure. And like I say, covered off by all of these things are run 90% through an SMSF, and it talks seamlessly to the SMS via Class, and it then gets seamlessly audited and signed off. So it's a full end-to-end process that works really well. And again, like the fees aren't that expensive to run it. Like Class is about $200 so Class does it for about $200 $300 a portfolio. We capped out at $2,700 on our admin fee. Doesn't matter if the client's got 50 mil, it's still $2,700 for admin. So you then just down to your investment management and asset management fee of the particular managers. You had a question?
Yeah. Thanks for your insights. Once you decided to go for the established affluent market, did you identify, in terms of a client acquisition strategy, any differences to what you do with a mass market? Is it more referral based, or did you employ a particular strategy there?
Yeah, no, all our works come out of direct client referral, and we always ask for them as well. And we would put on, when we put on any of our, that's the other thing that you've got to do. You put on these networking things. Like we had Jane Hume in for a boardroom dinner, and fully catered for, nice boardroom dinner. Jane Hume comes in, we get our top 10 clients in, and we said to our top 10 clients, bring a friend, and so they roll up. So we have 20 people for an intimate dinner with Jane Hume, talking about Australian politics. This is when the coalition was in power, rolling up to the election. So and they just thought, oh, geez, your advice of these things. We put on golf days and get people to bring people on. We put on our investment committee that talks and meet the managers. We get them to bring someone along, and people then get engaged in the process and go, because we find in this piece of world, like usually you've got business people, they all play golf and everything like that. They're selling their business and they go, I've just sold my business, I've got $15 million. Like our biggest client's got 70 mil, and we got no brand value. Paradigm has no brand value. So we're not UBS, we don't advertise, but still we've got the ability to attract, people with significant wealth because they got referred to us. And the person that referred that particular client to us was, we looked after a guy who used to run the Master Builders Association. We were engaged with a guy who sat on the board of CBUS, and that person the guy from CBUS referred that client to us. So we built our business, by actively looking for existing referrals, because we found that whenever we tried to engage with accountants and everything else, we found it to be a bit combative, and they're very protective of the client. They say to you, well, if you blow my client up, I've referred them to you, that means it blows up my relationship with my client. I hardly know you, Pat, so I'm not going to refer a client to you. We found that just a hard road to go down. So the best referral was the referral that you got from an we've been with Paradigm for 3 years, do a fantastic job, really happy with them. My wife's really happy with them. I'll give you an introduction if you like. So it's sort of how we've built our whole business actually. And look, and we've taken it through, I'll finish on this, we've taken it through the whole journey, because we started this business 20 years ago with nothing. Built that up. We sold 80% to IMAP, because we always had our view that we wanted to monetize what we created. We've now, IMAP and James Myers, my partner, and I, collaboratively have sold that now to Invest Blue. And why Invest Blue? Is that they got 12 bill under management. They're a growing business and they don't have a bespoke private client offer. And, so you start with the end in mind and go, I always thought when I built this business is going to sit seamlessly into a bigger group that is going to be able to utilise the skills and everything else that we've built so that they don't have to recreate it. And that's exactly what's happened. And so the next journey begins with our relationship with Investment.
Okay. Any more questions, folks? No? Can we all give a round of applause for Patrick?